All right, let's get right into it. Today we're looking at a huge showdown in the Indian tire industry, CEAT going head-to-head with JK Tyre. Now, these are two massive companies, but they have completely different playbooks. So let's break it down and see who's really got the edge right now. But first, before we dive into the rivalry, you have to understand the world they're operating in. And honestly, the Indian tire market is absolutely booming, which makes this whole comparison so important today. Just how big is this boom? Well, the entire industry is growing at a solid 6 to 8% every single year. That's a really healthy clip, and it tells you there's a ton of opportunity for anyone in this space. So, what's behind all this growth? It really comes down to two major things. First, we're seeing record-breaking sales of passenger cars. And second, electric vehicle adoption is just skyrocketing, up 17% from last year. It's pretty simple, right? More cars on the road means more tires are needed, period. And right in the middle of all this action are our two main players, CEAT and JK Tyre. They're both giants in this space, but as you're about to see, they're taking totally different roads to get to the top. Yeah, these companies are definitely not just copies of each other. They each have their own turf. CEAT, for instance, really dominates the market for smaller vehicles. Think two-wheelers, three-wheelers, and regular passenger cars. JK Tyre, on the other hand, is the absolute king of the heavy-duty world. They're the go-to for trucks and buses. And just to give you a sense of JK Tyre's scale, this isn't just an Indian powerhouse. We're talking about a global player. They are literally one of the top 20 tire makers on the entire planet. Okay, so now for the main event. Let's crunch the numbers. We're going to look at their recent Q2 performance to see how they really stack up financially. This is where things get really interesting. First up, let's talk revenue growth. In this round, CEAT takes the lead with a 14% jump compared to last year. And they did it mostly by just pushing more volume, selling more tires. JK Tyre wasn't far behind, though, with a very solid 11% growth of its own. Now, when we look at operating profit, CEAT pulls even further ahead. They posted an incredible 39% growth, partly because raw material costs were a bit more manageable. JK Tyre also did well, mind you, with a healthy 24% increase. But here's where it gets kind of wild. Even with those different growth numbers, if you look at their actual operating margins, they're almost identical. Both companies are hovering right around that 13% mark. That tells you that at their core, they're running their businesses with very similar efficiency. And here comes the plot twist. When you get all the way down to the bottom line, the net profit, JK Tyre's suddenly surges into the lead. They grew their net profit by a massive 62%. Now, CEAT's 54% is still fantastic, but JK Tyre's number, wow, that really suggests a laser focus on pure profitability. Okay, so performance is one thing, but what does the market think about these companies? What's their value? Let's take a quick look at their valuations to see how investors are pricing them. If you look at the PE ratio, which is kind of like the price tag on a company's earnings, CEAT's is a bit higher than JK Tyre's. But here's the really interesting part. When you factor in growth, using a metric called the PEG ratio, CEAT's number is just 0.37, and anything under 1 is generally considered pretty good. It suggests that, given its amazing growth, CEAT's stock might actually be undervalued. But look, it's not all just about company performance. There is one huge risk factor that hangs over both of these companies. In fact, it affects the entire tire industry. So here's the deal. A huge chunk, we're talking 60 to 65% of the cost to make a single tire comes from raw materials, things like natural rubber and other stuff that's tied to the price of crude oil. And that's the key takeaway, right? When the prices for those raw materials start bouncing all over the place, it can absolutely crush a company's profit margins. It's this constant wild card that neither company has full control over. So when you put it all together, what do we really have? Well, what we're seeing here are two completely different philosophies on how to win in the tire business. Let's boil it all down. On one side, you've got CEAT. Their game is all about volume. They're making an aggressive push to just sell more and more tires to grab a bigger piece of the market pie. Then you have JK Tyre. They're playing chess, not checkers. Their focus is squarely on the bottom line, using their dominance in the heavy vehicle space to make every single sale count. So you have aggressive growth versus disciplined profitability. Two very different strategies, both with their own merits. Which leads me to the final question, and this one's for you. Looking at everything, which company do you think has the better strategy for the long road ahead?